Well, good afternoon and welcome to the Nucleus Wealth Insight series entitled The Long-Term Trends in Focus at Nucleus Wealth. So my name's Tim Fuller, Head of Operations at Nucleus Wealth. And welcome to the sorry, I've got a bit of a sound double up here. Here we go. So what we'll do is we'll run through this over the next 30-35 minutes, looking at some of the key long-term trends with myself and Damien Klassen, our Head of Investments, which I'll introduce in a moment. And feel free to jot down any questions. We've got Matthew, our communications expert, watching the live chat window to pass through any questions to us to get answered live for you today as well. Quick disclaimer, obviously with any investment sort of webinar, you should always just treat it as general advice or general information only. And if you wish to act upon any of the themes discussed by myself or Damien today, we strongly recommend looking to or choosing to take up the advice of a relevant professional. And so what we'll move on to now is introducing Damien Klassen. So Damien has had a wealth of experience over 20 plus years working in some very large investment companies. And prior to that was a founding partner of a very specialised stock equity company known as Aegis as well. You can check out more information on Damien in our people section, which is just above you in the link on our webpage. So what we're looking at today is our, what Damien puts together as our 6 major long-term trends that are basically in consideration when he runs the portfolios at Nucleus Wealth. A bit of an agenda. So what we'll do is we'll look at really how to use these long-term trends and what these trends are, and then we'll finish off with how they are in use in the various portfolios that we run at Nucleus Wealth through the investment team.
Thanks, Tim. Look, the first, what I want to show is, what is a long-term trend, and it's more of a stylistic sort of view about how to use this. So what I've got here is this black line, which we can see gradually rising over time. The red line is the long-term trend that we're looking at, and then we've got the thing to note though is that we've got these blue lines where showing sort of medium-term trends that fit into this. And it is worth noting that these long-term trends can very much be knocked off by the medium term, whether it be recessions, booms, mining, commodity prices increasing dramatically, things like that. They can very much hide the effect of the long-term trend, but you do see the trend sort of come out the other side of these and be shown. So it's worth noting that these are long-term trends. You can lose money on them if you're trying to bet. You can lose money for a number of years if you're trying to bet solely on these long-term trends. You do need to take into account other factors, but these long-term trends sort of do emerge again following those periods.
Okay, yeah. So look, let's begin with trend number 1. So I can see here that from the next chart, our first trend is rising inequality. And look, inequality is a bit of a buzzword, really, isn't it? But how do you see it, Damien?
Look, I think it's worth noting. There's a bit of debate about inequality going on at the moment. I think most of the unbiased observers do note that inequality is very much rising. There's 2 different types of inequality. There's an income inequality and there's an asset inequality. And you can sort of juice the statistics on these, and particularly in terms of your if you want to try and look at total world inequality, you can get some numbers that don't look as if inequality has been rising as fast. And that's largely because you've been seeing countries like China and India catch up with the rest of the world and large populations in those countries. The important thing is, though, even if you break down the statistics within those countries, though, and look at the inequality within China, the inequality within India, or the US or Australia, so you look just within the countries, it's unambiguous that inequality is rising and has made significant increases over the last sort of 50 years.
Okay, yep. So what do you think the effect of inequality is?
Look, the effect the key effect is low demand. If the example to use is $1,000 given to somebody who's particularly rich, chances are they're going to save that money. They're not going to go out and spend it, or they'll invest it somewhere. Whereas if you give an extra $1,000 to the poorest members of society, chances are they're going to spend it, almost immediately on various things. So the more you have, the more money that accrues to the top 1%, the more you see this low demand, and that's very much been a feature of what we've seen over the last few years. The other effect is political instability. I like to say that people in net do work out that things are wrong, and they do see that wages are falling and that inequality is rising. Coming up with the reason for it, though, is where they usually come unstuck, and that's where you see the demagogues rise, and whether it be people telling you that building a wall will fix all your problems and fix your wage inequality, or they tell you that leaving Europe will fix your wage inequality. That's that's where some of the key dangers are. It's also worth to note gearing. So we're going to do some debt. So one of the other trends is debt. You can actually you can hide this trend by increasing debt.
Okay, yeah. So increasing debt's obviously a key thing there. But what do you think the other causes are?
Look, the causes. Some of it does come back to technology. So you do see the increase in terms of we've sort of got a rise in the value of capital over workers, over the value of workers. The main thing, not the main thing, one of the key things as well, I suspect falls into this, and certainly from looking at the graph you can see on screen, is the fall of communism does make a difference. So we went through this long period where through the sort of 40s, 50s and 60s and even into the 70s, where most capitalist countries were concerned about the rise of communism and so what that meant was they needed to make sure that the average worker continued to get decent wage growth. You didn't get these big inequalities because if you let inequalities go too far, then you'd get popular uprisings. Since the fall in communism, that seems to very much have gone by the wayside, and so I sort of feel as if that's has been a proximate cause and is no longer as much of an issue for the 1% in terms of worrying about populist uprisings.
Okay, so and I guess ultimately though, how do you think that this would all be resolved?
Look, it's tough to see a resolution to this. The Trump tax cuts are going to make things worse if they come through. For a while there, it looked like we had this popular backlash following the financial crisis, where we had this whole 1% and Wall Street sit-ins and things like that. That seemed to die away, and so I feel as if things will probably have to get a little bit worse before you see that sort of popular uprisings again, and so things will probably have to get worse before they're going to get better.
All right, very good. Thanks, Damien. So I can see here, so trend 2 is baby boomers, and obviously baby boomers have been blamed for a lot over the years. We've got the rise in house prices, rising in healthcare costs across the world, and even I've seen baby boomers being blamed for global warming. But what are they to blame for here?
Look, this one's more of a demographic issue. So I think what I'm trying to show here is that we have this big cohort of people born following the Second World War. So you can see in 1945 that the top left graph sort of shows a demographic chart about with the number of people in each demographic age group. So you can see them gradually falling away as people get older and die. By 1965, though, we'd seen this big boom. On the left-hand side, top right-hand chart, as the baby boomers were born. And then you see them move into the 1990s and then by 2012, very much making up the almost moving into that retirement stage. So one investment thing's been all about trying to chase what the boomers need next. So if boomers need houses, that's the investment. If now we're looking at retirement and healthcare costs, that's where you should be trying to position your investments.
Okay, great. So obviously this graph is for the US. Oh, sorry. At the top there. So this graph's for the dependency ratios in the United States. Can you explain what a dependency ratio is?
Yeah, so dependency ratio adds a little bit more to that prior analysis and gives you a better feel for how this is happening over time. So what a dependency ratio is, showing you how many workers there are for every person who's a non-worker. So how many workers are supporting the rest of the economy. So you can see that sort of hit a peak in that 1965 when we got sort of over 80% there of people that were dependent upon the rest of the people working. So the big bump there is the green line. So we can see that was the youth. So a lot of people, you had, I guess, one worker, a husband out there working with 3 or 4 kids at home, and potentially the wife not working as well. And then, but the bottom line then shows the old age. And so you can see as time went on, the number of workers gradually increased. So we hit this level of 60 workers, sorry, of 60 non-workers for every 40 workers. But now it's about to start changing again as the number of people, the number of people in old age in retirement starts to increase.
So more of us are working, and we're working for longer in the US anyway. But what are your thoughts elsewhere?
Look, things in the US are probably better than what you can see elsewhere. Japan's certainly a lot worse. They've got very low birth rates and very low immigration as well. Things are worse in Europe with similar trends, but not quite as bad as Japan, but similar. China had quite positive demographics until very recently. Their problem is the one-child policy, which is about to flip around as well in terms of their demographic issues. Australia is probably better than most of those, a little bit behind, but still with the same issues coming just a little bit further down the track.
And so, do you think all of this can be changed by immigration?
Look, at an individual level, you can make a difference with some immigration. The key thing for me, though, is we're a global investor and looking at global demand. Immigration merely just shuffles things around. So it's certainly not a long-term sustainable solution.
So if that's not the solution, how do you think all this can be resolved, Damien?
Look, I don't think this is one that has a resolution. I think this is one of those demographic trends where people are having fewer kids, and these trends take a very long time to play out. And so in the the next 10, 20 years, it's very hard to see anything unseating this trend.
Well, that's pretty grim. So we better move on to our third trend. So the third one we've got here is women in the workforce. Obviously, as everyone knows, been growing over many years. This looks like another demographic chart here, Damien. You might need to explain it, please.
Yeah, sure. So this is showing this is a US statistics, sort of showing participation rates. And so there are a couple of different ways to measure it. I'm going to show a different way to measure it on another one. But this is a very long-term graph. So it sort of shows that 14% of women were working in 1966, and now that's well over 50%. So the big increase in terms of GDP growth and things like that, as you had people coming from sort of being unpaid and not in the workforce to being in the workforce.
Okay, great. So so what is the difference between unpaid and paid work by women?
Look, in a way, this is one of these funny statistics that you get from a GDP. Is that if you had two families where both of them you have the husband working and the wife at home, that the husband's incomes are contributing to GDP, and that's it. If you then got both women to mind each other's children and both of them paid each other for that privilege, the net effect is you haven't changed anything. Kids are still being looked after by somebody, but GDP would actually increase significantly. So to a certain extent, you need to look beyond sort of headline GDP figures. But it is worth recognizing that there have been significant productivity gains in that have led to this growth, whether it be things like washing machines and dryers and dishwashers and vacuum cleaners and things like that have meant that people are a lot more productive in terms of what they're doing at home, and that sort of has been very much a driver that's allowed women to then go out and work and taken household chores that might have taken 5 or 10 hours shrink back to 1 or 2 hours, and at that stage people can actually go and work and contribute more.
Okay, fantastic. And as the father of a toddler, I think there's probably a bump in GDP just from having kids in general. But anyway, look, obviously this is the US graph, but what are your thoughts on what's happening elsewhere, Damien?
Yeah, so this next graph is different statistics, but a similar type of participation rate. And this is sort of showing that things are actually going backwards in the US over the last sort of 4 or 5 years. And very much at the OECD level, which is the OECD is a group of developed countries that participation has flattened. Australia can very much see that has flattened as well.
Okay, and I guess looking at Japan there at the lower pink line on your graph, is this a preview of the future, as it often is for many parts of the economy?
Yeah, absolutely. I mean, Japan's got some certainly bigger demographic issues than other countries, but it does show that participation rates have been falling for 20-some years there, and so it does seem to suggest that in developed countries it's come down to a more of a wants versus needs. So that basically what we're saying is that at a certain stage, people get to the part where if they're earning enough money and their lifestyle has increased to a certain stage, they can make a decision about whether they would like to work or whether they would like to stay home. And that it does appear that in developed countries for women, while it's been a huge driver for GDP over the last sort of 40, 50 years, it does seem to have reached an end and potentially, might be even a little bit negative in some countries.
Okay, fascinating. We'll move across to our fourth one here, and obviously it's a big part of many people's lives, and it's given, especially in Australia, the rising house prices, it's only getting bigger. You can see there that's a pretty dramatic chart, particularly in regards to private debt. Can you explain this one for us, please, Damien?
Yeah, look, I think this, personally for me, that you do find various explanations for it. For me, it comes back to inequality. The easiest way, we spoke about that before, where we have giving $1,000 to a rich person who wants to save it or invest it, and or versus giving to $1,000 to a person who is poor and they're looking to spend it straight away. If you do get an increase in, if you have increasing inequality, so the rich people are getting richer, one of the ways you can hide that is the rich person can take his $1,000 and lend it to the poor person. And if you've got falling interest rates and wage growth that's sort of ticking along, you can basically let the poor person can still keep spending the money, but they build up this debt behind it. And so in Australia, it's largely been private debt. In other countries, you do note that it's been public debt, and whether that's been shifting from public to private. But there's certainly some in my mind certainly significant links back to inequality that drive the debt. Okay,
great. So I guess ultimately, though, with the rising debt, particularly in Australia, what are your thoughts on how this debt's going to get resolved?
Look, there's really only two main ways you can resolve debt issues. The first is inflation. So if you've got a fixed amount, say $100,000 worth of debt, and your wage is increasing every year, then that $100,000 becomes less and less of an issue as your wages grow. So we want wages growth, and that's been one area where things have been very weak, in particular at the moment. So far, we've been quite unsuccessful at generating this inflation to sort of inflate the debts away. The second way is debt forgiveness or write-offs or bankruptcies. My take on this is it seems as if governments have collectively made a decision not to make investors pay for their mistakes. We've seen in Japan had a huge debt bubble in the 1990s, and they bundled up most of the debts into these zombie companies and sort of kept that flowing for kept that for sort of 20 years, gradually working its way down. The US, we had the housing loan crisis. We got massive government bailouts rather than making people take the losses. In Europe, we've seen Greek and peripheral debt, same type of thing. In China, in the early 2000s, they socialized a lot of the housing market when there were big losses there, and it looks like they're possibly heading for a similar, given the increases that you've seen in Chinese debt, they're quite possibly heading for something similar. So it does very much appear that making people pay for the mistakes in terms of investment is unlikely. You probably will see debt. You probably won't see sort of large scale write-offs or debt forgiveness, and so we're basically relying on inflation to pull us out of this.
Okay, so inflation looks like it's the answer to all our problems, and I think we could have a chat to the Venezuelans about this. But surely it's easy to create.
Look, absolutely. If we know how to create inflation, all you need to do is print more money. The big issue is, though, we created this central banking system to prevent government from being from printing money out of control. So we didn't want to end up in the Zimbabwe system or the Weimar Germany type outcomes. And so basically we've got this system where we're trying to create inflation without printing money, or at least by calling it something that doesn't look like it's printing money. And so we've put these constraints upon the system, which is the central banking system, which is sort of preventing inflation from being created. And we've seen Japan for sort of 20 odd years trying to create inflation and very much having problems with it. So we know how to create it. It's just we've put these constraints on us so that it makes it a lot harder to create inflation.
So once again, I guess Japan being a bit of a canary in the coal mine in the struggles in creating inflation. How do you think you see this one playing out, Damien?
Look, again, I think we're some way away from the end game. Again, as I mentioned, I think it's related to the inequality side. Until we see a decent movement on inequality, we're likely to keep seeing debt levels increase. And I think there are a lot of countries that do have scope. There's less scope than we had at the financial crisis, but there is still scope in terms of whether it be switching, say in Australia, switching private debt for public debt, and other countries, have room, as we can see from Japan, which has got quite astronomical levels of debt versus GDP. Having said that, though, you probably are going to continue to see debt crises from time to time, but yeah, it's one of these trends that really waiting on that inequality to resolve itself.
Okay, great. So we'll zoom across now to trend number 5, which is company tax rates. And I can see there from your graph that it looks like they're falling. It's pretty hard to fathom that company taxes have halved over the last 30 years. You might need to explain this one for us, please, Damien.
Yeah, companies have done a great job, haven't they, of lobbying and presenting this view to the rest of society that they don't need to pay taxes. I think a lot of this comes back to possibly some of the changing political processes and donations that companies can make, and companies just being a lot smarter about how they get what they want. So it's been very much a bit of a race to the bottom within countries. Okay,
and so obviously that's the last 30 years. But how do you see this changing in the future?
Look, the moralist in me would hope that we decide that companies are worth taxing at some stage, but the pragmatist says, look, it's not happening anytime soon. I think the changes at the moment are only for the worse. While this chart looks like it's sort of flattened out, the UK has just recently cut taxes. The US is looking at cutting quite significant cuts in corporate taxes. Australia is looking at cuts in corporate taxes. It very much is a race to the bottom.
Okay, and I guess, look, finally, from an investment manager's point of view, how do you see this sort of affecting the portfolios and the way we run money at Nucleus Wealth?
Yeah, I've got a table on this next slide which is worth looking at. This is showing long-term earnings per share growth. So a lot of it for me is all about coming back to saying, well, I want to put estimates going forward about how fast companies are going to grow versus into the future and what's realistic expectations. So we can see that companies grew earnings per share over the last 40, 50 years at about 6%. Now, if you take off the effect of inflation, about 2.8, so that brings us back to about 3.3%. The issue with that 3.3 is that almost 40% of it came from tax cuts. So 1.3% versus of that 3.3 came from companies having their taxes cut, which makes their earnings per share higher. So what it means is you can't overestimate some of these long-term growth rates. And I do look for a backlash. At some stage, I do expect to have a backlash against it, but it certainly doesn't seem to be happening anytime soon. And so right now, the play still seems to be looking at companies with high tax rates, let's say in the US, and expecting those tax rates to come back.
So ultimately, it's really just a movement from public purse to private purse and via a tax cut.
Absolutely, it's one of those, another one of those factors that's sort of leading to growing inequality.
Okay, wonderful. So we'll finish off now with trend number 6, and we're looking now at world trade. Now, this graph obviously shows a marked increase in the world trade over the last 50 odd so years. Do you consider this to be a good thing, Damien?
Yeah, look, absolutely. I think there's, the magic of trade is you have two people walk into a transaction and they both walk away thinking that they got something out of the deal. So trade in itself, I've got no problems with. Having said that, though, there are some negatives that do come about when you do get increasing world trade.
Okay, so let's just quickly run through the negatives on that side.
Sure. The biggest negative is in the short term is jobs. So what you need to make sure when you've got increasing world trade is that will displace jobs from one country to another country and create dislocations. You need to make sure that those people have work to get into and other jobs that they can actually go and do. So, one of the issues within that is close to home, Australia, we've lost a lot of our manufacturing capabilities as we've shifted all to a resources boom that was expected to last for considerably longer than it did. So that leaves us with an issue about finding jobs for those people. In the US, is probably even bigger. There's a whole section of the middle of the US in particular where they were very manufacturing heavy. As those jobs shifted offshore, you get a lot of unemployment and long-term unemployment in that, and quite potentially that's the type of without that environment, someone like Trump would have found it a lot harder to get elected.
Okay, great. And I guess obviously even on our own shores with the nigh decimation of manufacturing that we've seen over the last few years, and the car companies sort of dropping off the perch, it seems, every other year. What do you see as the sort of dangers there? Yeah,
look, the issue is whether Trump's spoken a lot about protectionism and whether he's renegotiating NAFTA or various rules on what companies can produce within the US and what they can't. The danger is in the 1930s, sort of following the Great Depression, you saw world trade fall by 60 or 70%, which very much exacerbated the economic problems that they have right throughout the 30s. So your dangers are, if this turns into a bit of a tit for tat and protectionism all around, then there is significant downside from where we are in terms of economic growth.
Okay, and where do you sort of see the parallels today?
Look, I don't think we've got the same types of issues. The Trump has spoken a lot about the trade issues. I think in the end, certainly the advisors around him and the Republican Party in general is pro-trade. And so I do think it's going to be a lot more noise than actual real tangible falls in the level of trade. And I think if you look globally, China, which is one of the rising players in the market, has very much been a real world success over the last 20 years from its increase in trade. And so it in particular is very keen to continue high levels of trade. And so I think while we're probably not going to see increased levels of trade, I think it's probably more of a flattening than going into a sort of 1930s style massive falls and rampant protection.
Well, that's good to know. And I guess just finally, in terms of these views on our investment portfolios, what's the effects there?
Yeah, again, it's sort of looking at companies where they have their manufacturing. We do a lot within our portfolios about trying to map companies to where they get their sales from versus where their costs are denominated in. So we spend a lot of time trying to work out, looking at various currency effects and trying to sort of play this as a currency. When one currency is high, we're looking to move out of the exporters in that country and more into the service companies there. And then as currencies fall, we then look to flip around. So at the moment, we're largely we've been looking for exporters within Europe in particular. With the rise in the euro over the last sort of 3 or 4 months, we're now starting to reverse that trade, starting to move out of a few of the European manufacturers and more into and the European exporters and more into the US companies.
Okay, fantastic. And just finally, I guess we've had 6 pretty major themes there. What do you see in bringing it all together? What's the summation of these themes?
Yeah, look, so it's worth noting the key message to take out of this is that we've had sort of 40 or 50 years of 5 really big tailwinds. So we've had female participation rising in the workforce, we've had favourable demographics, we've had rapidly increasing debt levels, and we've had increasing trade. So, and reducing taxes. So all of these have all been pushing growth a lot higher than we can expect it to be in the longer term. Flipping back around versus that is our headwind is increasing inequality. So increasing inequality has sort of been left in the dust by all 5 of those, sort of overwhelming it. So going forward, we've still got 2 headwinds. The baby boomer trend has turned, and we've got the rising inequality still going on. I've called them neutral with downside, but female participation and trade are both at best neutral, and there might be some downside if you see increased protectionism or that female participation rate continue to fall. On the flip side, there are still 2 tailwinds: corporate taxes, and increasing debt. Both of those have limits, but it doesn't appear as if we're right on those limits at the moment. So, I think in summary, often you do find that, to resolve this, you're probably going to need a bit of a lurch politically. And so maybe Trump's presidency might be one of these last straws, an extreme lurch to increasing the inequality by tax cuts and things like that might mean you get a backlash and a Bernie Sanders type person pop up, but we're talking years before we see that at best.
Okay, no, thanks for that, Damien. All right, and just finally, how do you plan on, I guess, with these major themes? How are we looking to use these in the investments here at Nucleus Wealth?
Yeah, now I just want to. I've popped up on the screen this graph again, just to remind you that these long-term trends, are the types of things you need to be considering it as a playbook that you're going to keep coming back to, but they're not going to dominate you short term. So when you get too far above that long-term trend is where we're looking to sell. Where below the long-term trend, we're looking to buy. So from an asset allocation point of view, my key message is lower growth in particular. So equities aren't on the growth front. The numbers we're putting into our models for what we're expecting in terms of companies to grow at is a lot lower than what it used to be. So that's the asset allocation. On the inequalities and the debt side, we are expecting more debt crises. It does seem that the current system is to increase debt and increase inequality, and then some short-term resolution through debt crises, but then off you go again. The important thing to note with these is they are spaced out, so you don't really want to be panicking too early on these. In terms of tax rates, the third one, it is still a play for higher tax rate companies. So it is worth, within our models, we look for higher tax rate companies and we look for other ways to compare them from a valuation perspective. So we reflect the fact that some of these might have lower taxes going forward. I do look for a bit of a backlash. So companies like Apple, Facebook, Google, we do a similar type of analysis, but we actually flip it back the other way and say, well, if the tax rates are 10 or 15%, we need to look at other valuation methods and actually make sure that it is still worth. We're not just buying them because they have a low tax rate, that we are buying them because the corporate earnings are actually worth buying as well. And the final one, the baby boomers trend is, I think it's probably a pretty well-worn one, is that healthcare and retirement services are places we'd like to keep investing in, but at the right price. It is worth, there's one of the statistics I like to trot out is that emerging markets, healthcare sort of trades about double the, about twice as expensive as the world market on emerging market healthcare, because everyone's trying to get into this trade about how do I get into to China and India and rising populations. So healthcare is one of the trends, but very much with an eye to getting it at the right price.
Okay, very good. Thank you for that, Damien. And what we'll do now is we'll move into our Q&A, and we've got a couple. We've got, just quickly check with Matt. Is there anything coming through from the live site? No.
No questions.
No questions just yet. So feel free to pop something through. We have got a couple that came through in email though. So one here is: are we investing, say the Trump trade, or are we looking at keeping everything balanced?
Sure. Look, I'm probably a little bit more balanced at the moment than what we usually are. Earlier on in the year, we went relatively heavily into Europe, and then reversed that trade as both the stock market there and the euro rose. So while we do have a sort of relatively synchronized global growth at the moment, I am sort of trying to find exposures within the US. The problem with the US is the exposures there tend to be a lot more expensive than what you see elsewhere. So at the moment, I'm agnostic in terms of, I think the valuations suit the growth profiles in a relative sense. There is an argument about whether markets themselves are expensive, and we are a little bit underweight equities on that basis, and we'll probably continue to sort of take some profits as the market grinds higher. But yeah, from a country perspective, it's about balancing the growth and the valuation, and in a relative sense, that's about right at the moment. We're largely now just looking for individual cases from country to country.
Okay, and just one last one as well. And once again, a call out to anyone who wants to jot something down in our live Q&A box. But looking more on local shores, obviously we mentioned there one of the big ones, one of the big trends was debt. How do you see that playing out in the Australian stock market in relation to, say, our banks, which are obviously a significant portion of our stock market? How are you placing the portfolios for this sector?
Yeah, look, I think the Australian banks have been called the widowmaker trade from a global perspective. There's a lot of international hedge funds and a lot of international investors who worry about the level of debt in the Australian economy, how much of it's all into the housing market, and they look upon that and they look at the growth rate in housing prices, and they think that's very much an unsustainable trade. Having said that, though, the question for this is all about timing, and the question is when do you see that trade start to turn? There's been several times in which we've seen the increasing shorts and things like that within the market, which have been an indication that people are trying to take that bet again, and most of the times they've been losing money on it. So we're very much in the wait and see period. We are concerned about it. We don't think what's happening in Australia is sustainable. But for the moment, so from an asset allocation perspective, our allocation to Australia is very low. Having said that, though, are there imminent issues? Could things be extended for a period of time? They could, and so we're not particularly. We're still sort of running with a decent exposure to Australian banks, although we are underweight.
Okay, fantastic. We've had a question come through here. So in regards to automation, will obviously the rise in automation that we've seen, across the world, have any sort of impact on employment, inequality, and the economy as a whole? And I guess how does that then reflect through is what we do as investment managers?
Absolutely. Yeah, look, definitely, I think it does play a big part. There is the issue. Comes back to what you're going to do. What are the jobs you're going to get for the people who are displaced by automation? Now, I don't doubt that we can create jobs for these people. I don't doubt that it's possible in the long term. The question is, if you get rapid changes and to come back to that, we can see over time that has happened. People spoke about whether it be the printing press or factories, in the 1800s, and the introduction of the steam engine and farm labourers and all these people will get displaced. We will find new jobs for them. The two key issues are how fast will it happen? Because if it happens quickly, then you get a lot of people displaced very quickly. And do you have governments who are prepared with sort of training and new jobs and things like that, new industries to be moving these people into? And I guess I worry that that on both counts, there's going to be issues. Is that one, I do think it will happen quite fast. And I think certainly in the transport industry, when that hits that point, I think the take up of smartphones and all these different new technologies probably means that the take up of driverless cars, when it does happen, whether it's now or in 5 years or 10 years time, I suspect when it does happen will be very quick. And so we will displace a lot of people very quickly. And so certainly one of the big issues I'm looking at, and I don't think governments have prepared, I don't think they are prepared for a large proportion and have training programs or new works to put them into. So yeah, I think it's a major issue. Not happening right now, but certainly as a key risk on the radar to continue to follow.
Okay, thanks very much, Damien. Great question. Anything else? No. Well, what we'll do, and just running, obviously mindful of time, is we'll just run into just a couple of quick things as an overview of what we do. So obviously, as investment managers and running our portfolios, we do it through what's called a separately managed account. We've managed to come to market with what we feel significantly lower fees than competitors in the market for what you get. You've obviously got examples of the experience of the investment managers that are looking after the money today, and obviously through the separately managed account we get these unparalleled levels of transparency. Just before I finish up, actually, we'll just have one more question come through. So I'll just grab Damien back again. So the question was, okay, so in regards to, back onto the debt again, in regards to private debt, do you know where it's located in Australia? Do you feel it's directed towards the wealthy or poorer households, or perhaps a mix?
Yeah, it is a little bit hard to tell with some of it. I think that the key issue is not so much as the house, from certainly the way international investors look at Australia, is not, is this from the wealthy or poorer households? It's what assets are backing it, and it tends to overwhelmingly be property. So property is not is not a particularly productive asset. Certainly at the yields you can buy it at now. And so I think the major concern for people in terms of private debt is that it's private debt based on the back of selling properties to other Australians. And so one Australian sells a property to another Australian, doesn't actually, even if they sell it at a 20% increase to whatever they bought it for last time, doesn't actually create anything new. And so the debt that's backing that is no more productive, and so that's the major concern.
Okay, no, fantastic. All right, well, look, on that note, well, thanks everybody for your attendance today, and I hope you enjoyed that. Feel free to come back to us with any further questions, and also we're running a series of webinars over this month and over the Christmas break as well, with any luck. So, just finally, we are going to be sending out a survey. So Matthew's going to fire out a survey to anyone who registered to attend today. If you'd like, just to give us a bit of guidance more than anything on what you'd be looking for in the future, feel free to fill that out. And in particular, any feedback, but also the topics that we've got there, or if you've got anything else of interest, please send it through. But thank you once again, and thanks for your attendance, and we look forward to seeing you around at the next one. Cheers.